Accounting assumptions, principles, conventions and concepts. In this lesson we learn everything about GAAP, generally accepted accounting principles, the most important rules, duality, the magic, business entity, realization, materiality, matching principle, prudence, money measurement, historic cost, consistency, going concern, substance over form. Identify and altogether we discuss and practice questions based on these concepts from exams. Accounting principles. Accounting principles are sometimes referred to as concepts and conventions. A concept is a rule which sets down how the financial activities of business are recorded. A convention is an acceptable method by which the rule is applied to a given situation. Business entity. Business entity. The business entity principle is also known as the accounting entity principle. This means that the business is treated as being completely separate from the owners of the business. The personal assets of the owner, the personal spending of the owner, etc. do not appear in the accounting records of the business. The accounting records relate only to the business and record the assets of the business, the liabilities of the business, the money spent by the business and so on. Everything is recorded from the viewpoint of business. If there is a transaction concerning both the business and its owner, then it is recorded in the accounting records of the business. When the owner introduces capital into the business, it is credited to the capital account to show the funds coming from the owner. The capital account shows a credit balance representing the amount owed by the business to the owner. When the owner makes drawings from the business, a debit entry will be made in the drawings account to show the value going to the owner, which reduces the amount owed by the business to the owner. Consistency. There are some areas of accounting where the choice of method is available. For example, there are several different ways to calculate the depreciation of a non-current asset. Where a choice of method is available, the one with the most realistic outcome should be selected. Once a method has been selected, the method must be used consistently from one accounting period to the next. This is known as consistency principle. If this is not done, the comparison of the financial results from year to year is impossible and the profit of a particular year can be distorted. There may be a good reason why it is necessary to change a method or valuation. In such a situation, the change may be made, but the effects of this should be noted in the financial statements. Duality. The principle of duality is also referred to as the dual aspect principle. Every transaction has two aspects, a giving and a receiving. The term double entry is used to describe how these two aspects of a transaction are recorded in the accounting records. Going concern. The accounting records of a business are always maintained on the basis of assumed continuity. This means that it is assumed that the business will continue to operate for an indefinite period of time and that there is no intention to close down the business or reduce the size of the business by any significant amount. This is the going concern principle. This continuity means that the non-current assets shown in the statement of financial position will appear at their book value, which is the original cost less depreciation, and inventory will appear at the lower of cost of net realizable value. If it is expected that the business will cease to operate in the near future, the asset value in the statement of financial position will be registered. Assets will be shown at the expected sales value, which are more meaningful than their book value in this situation. Historic cost. The historic cost requires that all assets and expenses are initially recorded in the ledger accounts at their actual cost. It is closely linked to the money measurement principle. Cost is a known fact and can be verified. Applying this principle makes it difficult to make comparisons about transactions occurring at different times because of the effect of inflation. Sometimes it is necessary to adopt a more prudent approach to ensure that the non-current assets are shown at a more realistic value, so the cost price is reduced by depreciation. Matching. The matching principle is also referred to as the actual principle. This is an extension of the realization principle to include other income and expenses. The revenue of the accounting period is matched against the cost of the same period. The timing of the actual receipts and payments is ignored. The figures shown in income statement must relate to the period of time covered by the statement, whether or not money has changed hands. This means that a more meaningful comparison can be made of profits, sales, expenses, and so on from year to year. Materiality. The materiality principle applies to items of very low value, items which are not material, which are not worth recording as separate items. Other principles can be ignored at the same time. Cost involved is in recording such low value items for outweigh and benefit to be gained from the strict application of those principles. For example, a pocket calculator purchased for office use is strictly a non-current asset, part of its value being lost each year through normal usage. The cost of calculating this and recording this each year would amount to more than the cost of the asset itself. Instead of the calculator being recorded as a non-current asset, it would be regarded as an office expense in the year of purchase. What is material for one business may not be so for another business. A laptop computer may be regarded as immaterial for a large multinational business, but would be material for a small sole trader. A large business may decide that non-current assets consist less than 1000 will be recorded as immaterial and be charged as expenses. Small business may have much a lower figure. This principle is also applied by entering small expenses in an account known as general expenses or fund expenses, rather than having individual ledger accounts for office expenses like light bulbs, flower displays, and so on. Materiality is also applied in relation to inventories of office supplies like envelopes, and the total cost of envelopes purchased in the year is treated as expense, even though there are some left at the end of the year. Money measurement. The money measurement principles means that only information which can be expressed in terms of money can be recorded in the accounting records. Money is a recognized unit of measure and is traditional way of valuing transactions. It does not rely on personal opinions and it is factual. There are many aspects of business which cannot be measured in terms of money and therefore do not appear in the accounting records. The moral of the workforce, the effectiveness of a good manager, the benefits of staff training course all play an important in the success of the business, but they will not appear in the accounting records as their value cannot be expressed in monetary terms. In a similar way, launch of rival product or increased competition cannot be recorded in the accounting records as their effects cannot be measured in monetary terms. Prudence. The prudence principle is also known as the principle of conservatism. This principle ensures that the accounting records present a realistic picture of the position of the business. However, the exercise of prudence does not allow the deliberate understatement of assets or income or the deliberate overstatement of liabilities or expenses. In short, prudence does not permit bias. Accountants should ensure that the profits and assets are not overstated and the liabilities are not understated. The phrase "never anticipate a profit but provide for all probable losses" often used to describe the principle of prudence. Profit should only be recognized when it is reasonably certain that such a profit has been realized and possible losses should be provided for. Prudence is a very important principle. If a situation arises where applying another accounting principle would be contrary to the principle of prudence, the principle of prudence is applied. For example, under the realization principle, profit is earned when goods actually change hands, but if the customer fails to pay after a reasonable time, the principle of prudence may be applied and the debt is written off. Realization. The realization principle emphasizes the importance of not recording a profit until it has been actually earned. This means that the revenue is only regarded as being earned when the legal title to goods or services passes from the seller to the buyer, who has then obligation liability to pay for those goods. When an order is placed by a customer, no goods change hand and no profit is earned. Profit is regarded as being realized when the goods actually change hand. This is the same even if the goods are sold on rate and the customer does not pay for them immediately. Substance over form. These words are used to describe the accounting treatment of something that does not reflect the legal position. For example, a machine bought on hire purchase remains the property of the seller until the final installment has been paid. If the purchaser fails to pay the installment as they become due, the seller may reclaim the machine. This is the legal position of the firm. However, the machine is being used in purchaser's business in the same day as the other machines that have not been bought on hire purchase. From an accounting point of view and for all practical purposes, the machine is no different from the other machine. This is the substance of the matter. The practical view is preferred to the legal view in the accounting treatment. This is known as substance over form.